Imagine this. It's a Friday afternoon. You're sitting at your desk and you open up your personal accounting spreadsheet or, your ledger book.
Oh, I know this feeling already. Setting the scene for a panic attack.
Exactly. So you check your cash record. And you're feeling pretty good because, according to your own meticulous records, you have exactly $10,000 to your name.
A nice, solid number.
Right. So you log into your online banking portal, fully expecting to see that sweet $10,000 balance just staring back at you.
But let me guess, it's not there.
It is not there. The page loads, you look at the screen, and the bank says you only have $8,000. Panic immediately sets in. Your heart just drops.
Yeah, that's a terrible feeling. You instantly think, where did the $2,000 go?
Exactly.
Yeah.
Did you get hacked? Did you, forget a major bill. Did someone at the bank make a massive mistake?
Right, your mind just races through all the worst-case scenarios.
Yeah, and that sheer cold panic that you feel in that hypothetical moment, that is exactly why businesses, from tiny corner shops to massive multinational corporations, absolutely require something called a bank reconciliation statement, or a BRS.
It's their financial safety net, basically.
Okay, let's unpack this. We have two ledgers that are supposed to be perfect mirror images of each other, our own records and the bank's records.
Right, they should be identical, in theory.
In theory, yeah. And yet somehow they are fundamentally disagreeing. So, to understand how we fix this, we have to look at the machinery running quietly in the background. We really have to look at what a bank actually is to a business.
Yeah, because the underlying relationship between a commercial enterprise and its bank is, well, it's the absolute foundation of modern commerce.
Right. It didn't always used to be this complex, did it?
Not at all. If we go back a few centuries, businesses operated almost entirely in physical cash, perhaps gold or silver coin.
Which sounds incredibly heavy and dangerous.
Oh, it was. And as trade expanded globally, dealing exclusively in physical cash became a massive bottleneck. It was inherently dangerous to transport, incredibly inefficient to count, and it basically placed a hard limit on economic growth.
So businesses just realized they needed a better system.
Exactly. They realized that relying on a centralized, trusted third party, which is what a bank is, was an absolute necessity for scaling operations.
And today, the legal and practical reality is that virtually every significant transaction a business executes routes through a bank, right?
Pretty much every single one. The bank is no longer just a vault. It's the central nervous system of a company's cash flow.
I think that vault misconception is where a lot of confusion starts for people.
Well, for sure.
People picture a bank as just this highly secure box where you throw your money and just hope it stays there until you need it.
Right, like a giant piggy bank.
Yeah. But the source material we are diving into today outlines that a bank's primary function is accepting deposits from the public specifically to lend those funds out.
Yes. It takes idle money and puts it to work in the economy.
And beyond it just holding and lending, the documentation lists 10 distinct key services that banks provide to customers. 10 of them.
That's a lot to keep track of.
It is. But if we are going to understand how bank statements behave, we need to completely wrap our heads around the sheer scope of what the bank is doing on our behalf.
Right, because any one of those 10 services can cause a discrepancy in your records.
Exactly. So let's go through them. For instance, the text mentions discounting promissory notes or hundies.
Right.
Now, that sounds like a totally archaic legal term to me. How does that actually function in a modern business context?
Well, a promissory note, or a hundi, in traditional regional commerce, is essentially a formal, legally binding IOU.
Okay, an IOU.
Yeah, let's create a scenario. Say you manufacture custom furniture. A corporate client buys a large order of desks from you, but they negotiate payment terms of 90 days.
Which is pretty standard in B2B sales.
Very standard. So they give you a promissory note, which is a guarantee to pay the full amount in 3 months.
Right.
Now, you have this piece of paper, which represents future wealth, but you have an immediate problem. You need to make payroll this Friday, and you need to buy raw lumber next week. You cannot wait 90 days.
So I take that piece of paper to the bank.
You take it right to the bank. The bank evaluates the creditworthiness of your corporate client, and if they are satisfied, the bank will, quote-unquote, discount the note.
Meaning they buy it from me.
Exactly. They purchase the IOU from you today, but at a slight discount to account for the time value of money and, the risk.
Oh, I see. So if the note is for $10,000, they don't give me $10,000?
Right. They might deposit, say, $9,800 into your account immediately, Then the bank waits the 90 days and collects the full $10,000 from your client.
Okay, so the bank makes a $200 profit for waiting, and I solve my immediate cash flow crisis so I can pay my employees.
Exactly. It's a win-win.
That makes perfect sense. It is basically a mechanism for unlocking trapped capital. Okay, another facility mentioned in the 10 services is the overdraft. Now, my understanding of a personal overdraft is a penalty state.
Right, like you spent too much at the grocery store.
Yeah, and then the bank hits you with a massive $30 fee for a $2 coffee. But for a business, an overdraft is an intentional facility granted to good customers, isn't it?
It is. It's a critical buffer
Yeah,
because, business cash flows are rarely perfectly smooth.
I can imagine.
Yeah, you might have a massive influx of cash on the 15th of the month when client invoices are paid, but you might have to issue vendor checks on the 10th.
So there's a 5-day gap where you are technically broke.
Right. And an overdraft facility allows your account balance to dip below zero, up to a pre-agreed limit. It ensures those vendor checks do not bounce.
Because bouncing a check to a vendor would severely damage your commercial reputation?
It would be disastrous. So the bank is essentially providing a short-term rolling line of credit, usually secured by your inventory or your receivables. And you only pay interest on the amount you overdraw and the actual time you remain in the negative.
Okay, so that bridges the gap for daily fluctuations. But the text also lists granting different types of loans as the third service, specifically differentiating between working capital and term loans.
Yeah, and the distinction there lies in the timeline and the purpose.
Okay, how so?
Well, working capital loans are often structured a lot like overdrafts or short-term revolving credit lines. They are designed to cover day-to-day operational expenses, wages, rent, utility bills, especially during seasonal dips in revenue.
Like a ski resort needing cash in July.
Exactly. Term loans, on the other hand, are highly structured. You borrow a lump sum for a specific long-term purpose.
Like buying a new building?
Yes, purchasing a new manufacturing facility, or maybe upgrading heavy machinery. You agree to a fixed repayment schedule over 3, 5, or 10 years. It is an injection of capital for expansion rather than just a patch for a monthly cash flow gap.
Got it. Okay, moving on. The fourth service is collecting dividend warrants or interest on securities.
Right.
So if my company has surplus cash and we invest it in government bonds or shares of another corporation, the bank acts as an administrative agent.
They do. They monitor those investments and automatically sweep the generated interest or dividends directly into your account.
So I don't have to hire a clerk to just track down dividend checks in the mail every month.
Exactly. The automation of cash collection is a huge value proposition for businesses.
Which leads right into the fifth service, making payments on standing instructions.
Right. The exact same principle, but in reverse.
Like paying the warehouse rent or the corporate insurance premiums automatically. You authorize the bank once, and they handle the recurring disbursements.
Yeah, it saves a tremendous amount of administrative time.
And moving on to the sixth service, the bank also facilitates the buying and selling of those financial instruments, shares, debentures, government securities. They almost operate as a brokerage arm, don't they?
They do. Commercial banks have really evolved into comprehensive financial hubs over the decades.
So a business doesn't need a separate broker.
Usually, no. By integrating brokerage services, a business can seamlessly move capital from their checking account into treasury bills or corporate bonds to earn a yield on idle cash.
And then just liquidate those assets back into cash when operational needs arise.
Exactly. All within the same banking ecosystem. It's highly efficient.
Okay, service 7 is remittance, which is moving money from one place to another. This seems incredibly basic today, but the mechanics of it are vital.
The mechanics are literally what make global trade possible.
Right, because before modern banking, transferring wealth meant physically moving gold or currency, guarded by armed escorts on horses or something.
Yeah, which is incredibly slow and risky. Today, remittance relies on a vast network of ledger entries.
How does that actually work behind the scenes?
Well, if you need to pay a supplier in London, you instruct your bank in New York. Your bank debits your account, communicates via a secure messaging network like SWIFT to a correspondent bank in London.
Okay.
And then that London bank credits the supplier's account. No physical money crosses the ocean at all.
Oh, wow. It was purely an exchange of information.
Yes, an exchange of information and reciprocal trust between financial institutions done rapidly and at a fraction of the cost of physical transport.
That concept of reciprocal trust leads directly into Service 8, furnishing security or guarantees.
Yes. bank guarantees.
The text specifically mentions this is for customers whose credit is good. What does a bank guarantee look like in practice?
Consider a construction company. Let's say they are bidding to build a new bridge for the municipal government.
Okay, massive project.
Right. The government needs absolute assurance that this company won't just go bankrupt halfway through the project, leaving a half-finished bridge sitting over a river.
That would be a nightmare, so they demand a guarantee.
They demand a performance bond or a bank guarantee. So the construction company's bank issues a formal document stating, if our client fails to meet their contractual obligations, we, the bank, will pay the municipal government a specified penalty.
Wow, so the government trusts the massive balance sheet of the bank far more than the balance sheet of the construction company.
Exactly. The bank is essentially monetizing its own pristine reputation to help the client win business.
That is fascinating. They are basically renting out their credit score to the construction company.
That's a great way to put it, yeah.
Okay, the ninth service is issuing letters of credit or traveler's checks. Now, we can probably skip traveler's checks since digital payments have largely replaced them.
Yeah, they're pretty much obsolete.
But letters of credit are heavily tested concepts, and they are crucial for anyone involved in supply chains, right?
Absolutely. Letters of credit solve the fundamental problem of trust in international trade.
Give me an example.
Imagine you are an electronics retailer in California, and you want to buy $1 million worth of components from a factory in Taiwan, but you have never done business with them before.
Okay, I would be terrified to send $1 million overseas before the goods are even shipped.
Exactly. What if they just take the money and vanish?
Right, and I assume the factory in Taiwan is thinking the exact same thing. We aren't going to load $1 million of inventory onto a cargo ship and send it across the Pacific, hoping this California company actually pays us when it arrives.
Right. It is a massive standoff. Neither side wants to take the risk.
So how does a letter of credit break that standoff?
The California buyer goes to their bank and requests a letter of credit.
Oh.
The buyer's bank sends this official document to the Taiwanese seller's bank.
Okay.
And this document is an irrevocable promise. It says, once the Taiwanese factory presents us with official shipping documents proving the goods have been loaded onto the vessel, we, the California bank, guarantee payment of the $1 million.
Oh, I see. So the seller now has the security of a major bank's promise, not just some random retailer's promise.
Exactly. So they confidently ship the goods. And the buyer is protected because the payment is only released upon verifiable proof of shipment.
It totally replaces the buyer's promise with the bank's promise. That is brilliant.
It really is.
Okay, and the final service, number 10, is general international banking services, handling foreign currency exchange and, mitigating the risks of shifting exchange rates.
Right. Managing currency risk is a huge part of international operations.
So looking at this comprehensive list, the bank is functioning as a lender, an investment broker, a payment processor, an international trade facilitator, and a guarantor. It's a lot.
It is a massive web of activity. But to manage all of this, the bank provides the customer with a statement, traditionally called the passbook.
Right, the famous passbook. The text describes it as merely a copy of the customer's account in the books of the bank.
Yes, it is the bank's way of maintaining transparency with you.
But the responsibility, however, lies heavily on the customer, doesn't it? The documentation explicitly notes that it is the customer's duty to review these entries and immediately notify the bank of any discrepancies.
It absolutely is your duty. The bank processes millions of transactions a day. They rely entirely on the client to verify the accuracy of their specific ledger.
And to do that verification, the business maintains its own parallel record. We call this the cash book, or more specifically for our purposes today, the bank column of the cash book.
Right. Every single time the business writes a check, makes a deposit, or authorizes a wire, the internal accountant records it in the cash book.
Okay, so this brings us to a conceptual hurdle that just absolutely tortures students and new business owners.
Oh, I know exactly what you're going to say.
When we look at these two ledgers side by side, we encounter what seems like a bizarre contradiction.
The opposite world.
The opposite world, yes. When I look at my business's internal cash book and a client pays me $10,000, I record that as a debit. It's an asset. I feel good.
Right. Debit equals good in your book.
But when I log into my banking portal, that exact same $10,000 deposit is labeled as a credit. This is the source of endless confusion for people. Why on earth are the labels flipped?
The confusion stems from a failure to shift perspective.
Yeah.
You have to anchor yourself in whose ledger you are actively reading at that exact moment.
Okay. Let's break that down. Let's start with the business's perspective, my cash book.
Right. When you deposit funds into the bank effectively becomes your debtor. The money sitting in that account is your asset. You have a legal claim on it.
So in the foundational rules of accounting, an asset account carries a debit balance.
Exactly. Therefore, an increase in your bank balance is recorded as a debit in your cash book.
Okay, I am the business. The bank is a highly secure liquid asset to me. Asset equals debit. Got it.
Good. Now, completely discard that viewpoint. Walk out of your office and walk into the bank's headquarters.
Okay, I am now walking into the bank.
You are now the bank's chief accountant. You are looking at the passbook, which is the bank's own internal ledger. When a customer deposits $10,000, does the bank suddenly own that money free and clear? Is it the bank's asset?
No. I mean, they can lend it out, but they have to give it back to me eventually.
Exactly. The bank has taken custody of those funds, but they have a strict legal obligation to return them to you upon demand. To the bank, the customer is a creditor.
So that $10,000 is actually a liability for the bank.
Yes. And in accounting, a liability carries a credit balance. So when the bank sends you a notification that your account has been credited, they are not congratulating you on your wealth.
Oh, wow. So what are they saying?
They are formally stating, our liability to you has increased.
That is wild. So your debit is the bank's credit.
Precisely. Your debit is the bank's credit.
This principle of mirrored ledgers is so vital to grasp. Let's construct a quick memory model to really lock this in for you, the listener.
Okay, let's do it.
If we are looking at a favorable scenario, meaning the business has its own positive cash sitting in the account, the cash book will display a debit balance.
Right.
And for that exact same positive reality, the passbook will display a credit balance.
Correct. Favorable equals debit in cash book, credit in passbook.
Okay, now what happens if the situation is reversed? Let's say the business is utilizing that overdraft facility we discussed earlier. They are in the negative.
If the business has overdrawn the account, the perspective flips entirely again. From the business's point of view, they now owe money to the bank.
The bank is no longer an asset.
Exactly. The bank is a creditor, a liability. Therefore, in the business's cash book, an overdraft is represented as a credit balance.
Okay, and flipping back to the bank's perspective.
Yeah.
If I owe the bank money, the bank views me as a debtor. I am an asset on their balance sheet because I am obligated to pay them back, plus interest.
Right. So in the bank's passbook, your overdraft shows up as a debit balance.
The summary is elegantly simple, even if it takes a minute to really internalize. A favorable balance is a debit in the cash book and a credit in the passbook.
Yes.
An unfavorable or overdraft balance is a credit in the cash book and a debit in the passbook.
The nature of the balance is fundamentally different because the business enterprise treats the bank as a trade receivable, while the bank treats the business enterprise as a trade payable.
Okay, we have established the theoretical perfection of these mirrored ledgers, but going back to our initial scenario, that Friday afternoon panic over the missing $2,000, that was all about the reality that these ledgers frequently do not match.
They rarely match perfectly on any given Tuesday.
Right. So if they're supposed to be perfect mirrors, why do we dedicate an entire formal accounting procedure to reconciling them? What is the core purpose of a formal bank reconciliation statement?
At its most basic level, a BRS is just a document that identifies, explains, and reconciles the differences between the balance shown in your cash book and the balance shown in your passbook on a specific date.
But it's more than just a math exercise, right?
Oh, absolutely. Its true value lies in internal control and corporate governance. We perform this reconciliation regularly,
Yeah.
monthly or even daily in high-volume environments because the alternatives are chaotic and highly susceptible to fraud.
That brings up a great point. The source text actually includes a rather stark scenario regarding embezzlement.
Oh, the cashier example.
Yeah. It notes that without reconciliation, a cashier could simply record a customer payment in the internal cash book, creating the illusion that the money was safely banked, but then physically pocket the cash instead of driving it to the deposit window.
Which happens more often than you'd think in businesses with poor controls.
Really? Just pocketing the cash?
Yes. And what's fascinating here is how the BRS acts as a structural defense against exactly that kind of opportunity. In forensic accounting, we talk about the fraud triangle.
The fraud triangle, what is that?
It consists of opportunity, pressure, and rationalization. Now, a business cannot easily control an employee's personal financial pressure. Maybe they have gambling debts or their moral rationalization.
Right, you can't control what's in someone's head.
Exactly. But a business can absolutely eliminate the opportunity. If a cashier knows that an independent party like an auditor or a senior manager will compare the internal cash book against the external bank statement at the end of every single month, the opportunity for that specific type of theft vanishes.
Because the fake entry in the cash book will immediately clash with the reality of the passbook. The money won't be there.
Precisely. They would be caught within 30 days.
The text highlights several salient features that make the BRS such a powerful tool. Beyond just discouraging embezzlement, it is the primary mechanism for exposing simple human errors.
Right, yeah. Mistakes made by either the company's accounting staff or the bank's personnel.
It also brings attention to undue delays in the clearance of checks.
And that clearance delay is a vital operational metric. If you deposit a major payment from a client and the BRS reveals that it still hasn't cleared the banking system 2 weeks later, management absolutely needs to know about that.
Because it means something is wrong.
Right. Perhaps the client's check bounced, perhaps it was lost in transit by the mail carrier, or perhaps there is some regulatory hold on the funds. The BRS surfaces these bottlenecks so they can be actively investigated.
So ultimately, the reconciliation process ensures that all financial transactions are properly accounted for, allowing management to ascertain the true, verifiable position of their liquid assets.
That's the goal. Verifiable truth.
Okay, so we know why we need to investigate. Now we need to look at the suspects.
Yeah.
When we lay the two books side by side and find discrepancies, those differences almost always fall into one of three broad categories, right?
Yes, three main culprits.
Timing differences, bank-initiated transactions, and outright errors.
That covers about 99% of all discrepancies.
Let's explore the mechanics of each, starting with timing. I tend to think of this as the friction of physical reality. Time travel isn't real, and neither is instantaneous global ledger updating, at least not in traditional banking.
The friction of physical reality is an excellent way to conceptualize it. A transaction is frequently recorded at two completely different times in the respective ledgers, purely because of the physical or procedural steps required to finalize the movement of money.
Give me a breakdown of how that works.
Let's examine the most common example. A business writing a physical check to a supplier. The instant the authorized signatory signs that check and hands it over, the company's internal accountant will logically record that payment in the cash book.
So the internal balance drops immediately on Tuesday at 2 p.m.
Yes. But the bank is completely blind to this event. That check is sitting in the supplier's briefcase, or maybe it's traveling through the postal system.
Right, the bank has no idea you even wrote it.
Exactly. Even when the supplier finally receives the check, they might wait a few days before visiting their own bank to deposit it. And once deposited, the supplier's bank must route that physical check or its digital image through a central clearinghouse to demand the funds from your bank.
Which takes days.
Right. Throughout this entire multi-day journey, your cash book reflects a lower balance, while your bank's passbook remains blissfully unaware, reflecting a higher outdated balance.
And no one has actually made a mistake here.
No mistake at all. The ledgers are simply out of sync temporarily due to physics and bureaucracy.
And the same logic applies in reverse when our business receives a check, right? We log it as an asset instantly in our cash book. We feel richer.
But the bank won't credit your passbook until they successfully extract the funds from the payer's bank, which again takes days.
Okay, the second category of discrepancy is bank-initiated transactions. These are events that occur entirely within the bank's ecosystem, and the business is effectively kept in the dark until the statement arrives at the end of the month.
Yes. Banks routinely execute transactions based on pre-existing agreements, without seeking real-time permission from you for each individual instance.
Like what?
Well, they might credit your account with interest earned on a minimum balance, or more frequently, they will debit your account for various service charges.
Like monthly account maintenance fees or overdraft interest?
Exactly. Fees for issuing new checkbooks or charges for SMS alerts.
So the bank updates the passbook instantly, but my cash book is just totally ignorant. My internal balance is artificially high because I haven't deducted all those little $5 and $10 fees yet.
That's a very common scenario.
Yeah.
Another major source of bank-initiated transactions is direct payments.
Direct payments, like wire transfers.
Yeah. A customer might owe you money and decide to bypass the check writing process entirely. They initiate an electronic transfer directly into your account. The bank receives the funds and updates your passbook.
But unless I have real-time notification systems integrated into my accounting software, my human accountant won't know to update the cash book until they actively check the portal.
Right. During that delay, your cash book balance is lagging behind.
Which brings us to the third category, errors. Human or systemic mistakes made in preparing the accounts. Now, as someone who frequently makes typos in spreadsheets, I totally understand customer errors.
We all do it.
We write a transaction on the wrong side of the ledger, or we transpose numbers, writing 540 instead of 450. But do massive, heavily regulated banks really make errors? I mean, they have supercomputers.
They do make errors, yes. Though, to be fair, at a significantly lower rate than human bookkeepers.
How does a bank make an error?
Bank errors often stem from the intersection of legacy technology and human intervention. For example, when a physical check is deposited, automated systems use optical character recognition, or OCR, to read the numbers on the paper.
Okay, scanning the handwriting.
Right. If the handwriting is poor, the OCR might misread a $1,000 check as a $100 check.
Oh.
Or if a human teller is manually keying in a deposit slip, they might accidentally apply the funds to an account number that is one digit off from yours. Because errors can originate from either side of the relationship, the BRS is the critical safety net to catch them.
Okay, we have the theory down. Now we need to really get our hands dirty with the actual mechanics. This is the core of exam preparation and practical application. We are going to visualize the math behind specific common discrepancies.
This is where the rubber meets the road.
We need to determine if a specific event causes the cash book balance to be greater than or less than the pass book balance. So let's start with scenario A. A check is issued by the business but not yet presented for payment. Let's build a timeline for this.
Okay, let's assume a baseline of harmony. Both the cash book and the pass book start the month with an identical, favorable balance of $10,000.
Okay, $10,000 in both books.
On a Tuesday, the business issues a check for $2,000 to a vendor. The internal accountant immediately logs this withdrawal. The cash book balance drops from $10,000 to $8,000 instantly.
But the vendor puts the check in their pocket, goes on vacation, and forgets about it for a week.
Exactly. The bank remains completely unaware, so the pass book balance stays at $10,000.
So if we freeze time right there and compare the ledgers, the cash book sits at $8,000, the pass book sits at $10,000.
And the result of this specific timing difference is that the cash book balance is less than the pass book balance.
Okay, let's flip the scenario. Scenario B. A check is deposited into the bank but not yet cleared.
Again, we start in harmony. Let's say a balance of $12,000 in both books this time.
Okay, $12,000.
The business receives a check from a client for $3,000. The accountant logs the deposit immediately. The cash book balance aggressively climbs to $15,000.
And the check is handed to the bank teller, but the funds are drawn on a bank in another state. Let's say it takes 3 business days to clear through the central banking system.
Right. During those 3 days of transit, the bank will not officially credit your passbook. The passbook remains anchored at $12,000.
Freezing time again. The cash book is highly optimistic at $15,000. The pass book is conservative at $12,000.
So in this scenario, the cash book balance is greater than the passbook balance.
Okay, that makes total sense. Let's move to scenario C, bank-initiated movements. What happens when the bank allows interest on our balance?
Well, the bank's computer system automatically calculates the interest and adds it to your account in the middle of the night. The passbook balance increases.
And me, sitting in my office, I haven't received the monthly statement yet.
Right. Your cash book is unaware of this new income. Therefore, your cash book balance is temporarily lower than the passbook balance.
And the reverse situation. The bank debits our account for service charges or interest on an overdraft.
Same logic. The bank extracts their fee, immediately lowering the passbook balance. Your internal cash book is oblivious to the deduction, remaining artificially high. In this case, the cash book balance is greater than the passbook balance.
What about direct electronic payments? The source text specifically mentions systems like NFT and RTGS. For clarity for you listening, NFT is National Electronic Funds Transfer, which processes batches of transactions throughout the day, and RTGS is real-time gross settlement, which is used for high-value transactions and settles almost instantaneously. How do these affect the balance?
These are push payments. A client pushes money directly from their bank into your bank.
Okay.
The moment the transfer clears the central system, your bank credits your account. The passbook balance rises immediately.
However, unless your internal accounting software is tied directly into an API providing real-time banking alerts,
Your human accountant won't know to update the cash book until he actively checked the portal or receive a statement.
right, so during that delay, your cash book balance is lagging behind, making it lower than the true passbook balance.
Exactly.
All right, now let's tackle scenario D. This is the one that causes the most headaches for students. The dishonor of a bill discounted with the bank, or basically a bounced check.
Oh, this one is tricky because of the psychology involved.
The psychology of the transaction. Let's walk through a detailed narrative of that. Let's say a business owner, Mr. X, has a stable bank balance of $20,000.
Okay. Mr. X starts with $20,000 in both ledgers. A customer arrives and pays an outstanding invoice with a check for $3,000.
Okay. What is the immediate psychological and accounting reaction for Mr. X?
Well, he assumes the check is perfectly valid. He's happy. He happily records a $3,000 deposit in his cash book. He now believes he has $23,000 in liquid assets.
He goes to the bank.
He deposits the physical check at the bank. The bank accepts the piece of paper and begins the clearing process. But 3 days later, the other bank sends a message back. Insufficient funds.
The dreaded bounced check. It is dishonored.
Right. Because the funds could not be collected, the bank never actually adds the $3,000 to Mr. X's passbook. The passbook balance remains anchored at the original $20,000.
But the situation actually worsens, doesn't it? It does. Processing a bounced check costs the bank administrative time, and they penalize the depositor. They levy a dishonor fee, let's say $100. They deduct this fee directly from the account.
Ouch.
So the passbook started at $20,000, ignored the bounced $3,000, and subtracted $100 for the penalty. The final passbook balance is $19,900.
This creates a massive divergence. Mr. X's cash book is sitting way up at $23,000, inflated by a phantom deposit and totally ignorant of the penalty fee. And the passbook is down at $19,900, reflecting the grim reality.
Right. And when Mr. X finally receives the statement, the reconciliation requires dismantling his previous assumptions.
How does he fix it?
To fix his cash book, he cannot simply subtract the difference. He must conceptually reverse his errors. First, he must subtract the $3,000 to eliminate the phantom deposit. Second, he must subtract the $100 to account for the new bank fee.
So $23,000 minus $3,000 minus $100 brings his cash book in line with the reality of the $19,900 passbook.
Exactly.
That step-by-step breakdown is so crucial. It shows that you aren't just doing abstract math, you are correcting a historical narrative.
That's a perfect way to phrase it.
Now, we need to transition from understanding the discrepancies to actually building the formal reconciliation statement. We are stepping into the role of forensic accountants now. How do we take a list of known discrepancies and organize them into a coherent document that proves the two ledgers actually reconcile?
Building the statement requires establishing a starting point and a destination. You're basically trying to build a mathematical bridge between the two books.
Okay, a bridge.
In any given scenario, you will be provided with one of four possible starting points. 1, a favorable debit balance as per the cash book. 2, an unfavorable credit balance or overdraft as per the cash book. 3, a favorable credit balance as per the passbook. Or 4, an unfavorable debit balance or overdraft as per the passbook.
So you select your starting balance.
You select your starting balance, and your singular objective is to systematically add or subtract the discrepancies until your final calculated number perfectly matches the balance of the other book.
Okay. The source outlines a fundamental rule for deciding whether to add or subtract a discrepancy. I call it the golden rule of target matching. It states, and I'm quoting here, if the balance of the other book is more on account of the cause, add. If the balance of the other book is less, subtract.
It's mathematically sound, but yeah, it's a bit wordy.
That wording can feel a bit dense for students. Let's create an analogy to make it stick.
Let's use the analogy of synchronizing a wristwatch to a master clock.
Oh, I like this.
Imagine you're wearing an analog wristwatch. You walk into a train station that features a massive, highly accurate wall clock.
Okay.
Your wristwatch represents your starting point, the balance you are currently holding. The wall clock represents your target destination, the balance of the other book you're trying to reach.
So watch is start, wall clock is target.
Exactly. Your goal in this exercise is not to debate whether the wall clock is morally correct or if it accurately reflects reality.
You don't argue with the wall clock.
You don't argue with it. Your only goal is to manipulate your wristwatch so that its hands match the wall clock perfectly.
Okay, so if I look up and the wall clock indicates a time that is 5 minutes further ahead than my watch, what is my action? I advance or add 5 minutes to my watch.
Precisely. And if the wall clock is 10 minutes behind your watch,
I wind my watch back, subtracting 10 minutes.
that's target matching. Whatever the target book did, you force your starting book to do the exact same thing. You blindly follow the target.
I love that. Blindly follow the target. Let's put this philosophy to the test with a complex multi-step walkthrough based on the source text example involving a company called Nagpal & Co.
Okay, let's dive into Nagpal & Co.
We are going to make the passbook balance our starting point, our wristwatch. Our target destination, the master wall clock, will be the cashbook balance.
Right. Let's apply the rule methodically to each discrepancy. We begin our statement with our starting point, the balance. As per the passbook, let's say it is a massive $3,082,000. That is the time on our wristwatch.
Yeah.
We investigate the records and uncover our first issue. The business issued 2 large checks to suppliers, one to K. Nagpal & Co. for $73,000 and one to B. Babu & Co. for $78,000.
Okay, large payments.
These checks have been entered into our internal cash book, but they have not yet been presented to the bank, so they are missing from the passbook.
Okay, let me apply the rule. Our target is the cash book. What happened in the cash book when those checks were written? The internal accountant recorded the payments, so the balance of the cash book went down. The target is lower.
Therefore, to make our starting passbook match the lower target cash book, we must mimic that action. We subtract the unpresented checks. We deduct $73,000 and $78,000 from our starting balance.
And it doesn't matter that the bank actually still has the money in reality. If the target book went down, we force our starting book to go down. That is the beauty of target matching.
Exactly. Let's look at the next discrepancy. The bank collected $20,000 in interest on some government securities we own. This $20,000 appears as a deposit in the passbook, but we haven't recorded it in the cash book yet.
Okay, identify the target. The target is the cash book. Does the cash book know about this $20,000 deposit? No.
No, it doesn't.
Therefore, the cash book balance has not been increased by it. The target is conceptually lower because it is ignorant of the new wealth.
Right. Our starting point, the passbook, already includes this $20,000. It is sitting artificially high relative to the target. To match the ignorant target, we must back that money out. We subtract the $20,000 from our starting balance.
We have to pretend we didn't get the money to match the book that doesn't know about the money. Perfect.
It feels counterintuitive, but it works every time.
Okay, the final discrepancy in this Nagpal example. There are withdrawals totaling $26,000 recorded in the passbook. This includes a $25,000 insurance premium paid via standing instruction and $1,000 in various bank charges. However, these deductions have not yet been logged in our cash book.
Let's apply the rule. The target is the cash book. Has the cash book deducted this $26,000? No.
Because it hasn't recorded the expenses, the target cash book balance is sitting artificially higher than reality.
Right. Our starting point, the passbook, has already settled these deductions. Its balance is lower. To force our starting book to match the artificially high target book, we have to reverse reality. We must add the $26,000 back to our starting balance.
And if you follow this strict target matching logic for every single discrepancy, the final calculated number will perfectly equal the balance of the cash book, mathematically proving that the only differences between the two ledgers are the specific identifiable timing and transaction gaps.
That is the magic of the BRS.
So what does this all mean for someone studying this? It means you can throw away those massive memorization tables. You do not need to memorize a list of 40 different scenarios dictating when to add and when to subtract.
Please don't memorize them. The memorization approach is so fragile. One slightly reworded exam question will shatter it.
You only need to ask one analytical question. Did this specific transaction make my target book's balance higher or lower? And then you execute that exact mathematical movement on your starting book.
It's a much more robust way to learn.
But this entire process assumes someone has politely handed you a neat list of discrepancies.
Which never happens in real life.
Exactly. In the actual operations of a business, you aren't handed a list. You are handed 2 massive, incredibly dense ledgers and told, figure out why we are missing $2,000. How do we find the unknown causes?
Finding unknown causes requires a methodical, line-by-line comparison technique, generally referred to as the tick mark method.
The tick mark method, how does that work?
You place the physical or digital cash book and the passbook side by side. You must remember the principle of mirrored ledgers. The opposite world, you cannot compare debits to debits.
Right, because my debit is the bank's credit.
Exactly. You begin by comparing the debit entries of the cash book, which are your recorded deposits, against the credit entries of the passbook, which are the bank's recorded deposits. You trace every single line.
Wow, every line.
Every single one. When you find a matching amount with a corresponding date, you place a distinct pencil tick mark next to the entry in both books.
Okay, tick, tick, tick.
Once the deposits are cleared, you shift to the withdrawals. You compare the credit entries of the cash book
against the debit entries of the passbook.
And when you have exhausted both ledgers, the solution reveals itself, right?
It does. Any item remaining in either book that does not possess a tick mark is an anomaly. Those unticked items are your culprits. They form the list of discrepancies you will use to build your reconciliation statement.
It sounds tedious, but it is mathematically foolproof.
It is tedious, but it's necessary.
However, the source material warns about a major operational trap hidden within this process, specifically regarding the transition between months. Let's explore the opening balance trap.
Ah, yes, the opening balance trap.
Imagine we were sitting down on June 1st to reconcile the books for the month of May.
This is a classic point of failure in both exams and real-world accounting. Let's set the stage. You look at the cash book for May. It opens on May 1st with a favorable debit balance of $1,000.
Okay, $1,000 in the cash book.
You then look at the passbook on May 1st. Its opening credit balance is not $1,000. Perhaps it is $80,000.
Wait, the opening balances themselves are fundamentally out of sync before the month even begins.
Exactly. They don't match. But you ignore that for a moment and proceed with your tick mark method for the May ledgers. In the passbook, you find an unticked withdrawal on May 7th. A check cleared for $30,000 paid to a supplier. Let's call him Mr. A.
Okay, so I scour the May cash book for this $30,000 payment, but it is completely absent. There is no record of paying Mr. A anywhere in May.
Right. And the immediate instinct for a junior accountant might be panic. We never recorded this payment. We've uncovered a massive error.
But that instinct is likely wrong, isn't it?
It is. The clue is in the mismatched opening balances. If the balances didn't match on May 1st, it implies that the April reconciliation was left with unresolved timing differences.
Oh.
That $30,000 check to Mr. A was almost certainly written and recorded by the business in late April. The accountant properly learned it in the April cash book.
But Mr. A was slow to deposit it, and it didn't clear the banking system until May 7th.
You got it. Therefore, the transaction physically appears in the May pass book, but it will never appear in the May cash book because its internal accounting life cycle was completed in the previous month.
So when you are confronted with mismatched opening balances, you have to mentally categorize your unticked items. Category 1 consists of items relating to the reconciliation of the opening balance, the ghosts of the previous month finally clearing, like the check to Mr. A.
Right, the ghosts of April.
And Category 2 consists of items relating to the current month's activity, the new discrepancies that will form the basis of the current closing balance reconciliation.
Yes. For example, if you find an unticked item in the passbook on May 29th for monthly account maintenance fee, $2,000, that is a Category 2 item. It's a fresh discrepancy that needs to be added to the current BRS.
Disentangling the historical timing differences from the current month's operational differences is such a vital forensic skill.
It really separates the novices from the professionals.
Now let's talk about handling pure, unadulterated human errors. Timing differences are natural, but sometimes people just mess up.
Unfortunately, yes.
The source mentions errors like commission, incorrect amounts, writing on the wrong side of the ledger, or just faulty addition. Let's analyze the Vandy Ltd error presented in the text, because the math is a fantastic logic puzzle.
Bank errors provide excellent test cases for really understanding the mechanics of reconciliation. Let's establish a scenario.
Okay.
The internal accountant has calculated the closing balance of the cash book to be $1,048,000.
$1,048,000.
The bank statement arrives, and the closing balance, as per the passbook, is a wildly divergent $3,028,000.
Whoa! That's a huge difference.
It's massive. So an investigation is launched, and a severe mistake is discovered at the bank regarding a check involving a company named Vandy Ltd for the amount of $1,080,000.
Okay, the text states it was a check to Vandy Ltd. That phrasing implies the business issued the check to pay a vendor. Therefore, it was a withdrawal. It should have reduced the bank balance.
Exactly. It should have been processed as a debit to the customer's account, lowering the passbook balance. However, the bank teller, or the automated system, made a catastrophic error. Instead of subtracting the $1,080,000 check, they accidentally processed it as a deposit.
Wait, they added it?
They added $1,080,000 to the existing balance.
This is a double impact error. If you are supposed to take a step backward, but instead you take a step forward, you are now 2 steps away from where you should be. How do we build a reconciliation statement to mathematically prove this bank error and bridge the gap between the 2 ledgers?
We rely on our trusted strategy, target matching. Let's make the incorrect passbook our starting point, our wristwatch. It sits at a highly inflated $3,028,000.
Okay.
Our target master clock is the correct cash book balance of $1,048,000. We must look at the starting point and ask, How did this error affect this specific ledger?
Well, the bank erroneously added $1,080,000. The passbook is artificially high by that exact amount relative to the pre-transaction baseline.
Right. To bring our starting point in line with reality, and to match the target cash book, which correctly did not receive a phantom deposit, we must reverse the bank's mistake on our statement.
So we subtract the erroneously added $1,080,000 from the starting passbook balance.
Yes. And $3,028,000 minus $1,080,000 equals $1,048,000.
Wow. The math perfectly bridges the gap, proving that the entire discrepancy is entirely due to this single massive banking error.
It's very satisfying when the numbers align like that.
That highlights why the target matching logic is so superior. You don't have to panic over the double impact nature of the error in reality. You just look at what the error physically did to the ledger you were starting with, and you reverse engineer it to match the target.
Exactly. Don't overthink the reality, just follow the mechanical rule.
This brings us perfectly to the final phase of our deep dive: exam focus, common mistakes, and retention review.
Oh, this is the good stuff.
I'm going to rapid fire some realistic scenarios that consistently trip up students, and I want you to break down the underlying logic.
I'm ready. Let's do it.
First scenario. I open my exam paper. The very first line of the question states, prepare a bank reconciliation statement starting with a debit balance as per passbook of $5,000. My initial reaction is, debit means asset, so I have a positive $5,000. Am I correct?
You are falling into the most common trap.
I knew it.
You have forgotten to flip your perspective.
Okay.
While a debit is an asset in your internal cash book, you are looking at the passbook, the bank's ledger. To the bank, a debit balance means they view you as a debtor. You owe them money.
Ah, the opposite world strikes again.
Yes, a debit balance in the passbook represents an overdraft. You are starting your reconciliation with a negative $5,000 balance.
Okay, that is a tricky one. Next scenario. I uncover a discrepancy during the tick mark phase. The scenario says, bank charges of $50 were recorded twice in the cash book by mistake. My target destination for the statement is the passbook. How do I adjust my starting cash book?
Break it down sequentially. What happened to the target book?
Yeah.
The bank legitimately charged you $50 once, so the passbook went down by $50. What happened to your starting book? The clumsy accountant recorded the $50 charge and then accidentally recorded it again. The cash book went down by $100.
Right.
Compare the two. Your starting cash book is $50 lower than your target passbook because of the extra erroneous deduction. To force your starting book to match the target, you must reverse the extra deduction. You ADD $50 back to the cash book.
Perfect. Let's try one more. A customer check for $1,000 was deposited, it bounced and was dishonored, but absolutely no entry was made in the cash book to reflect the bounce. My target destination is the passbook.
Trace the timeline. When you deposited the check, you immediately added $1,000 to your cash book.
Right.
The check bounced. The bank never collected the funds. Therefore, the target passbook did not increase. Your starting cash book is sitting on $1,000 artificially higher than the reality of the target passbook.
So to make my starting book match the target, I must eliminate the phantom wealth. I subtract the $1,000 from the cash book.
You got it. You are repeatedly emphasizing a crucial philosophy here. The math is secondary. The narrative is primary.
I've watched students waste hours trying to memorize exhaustive lists of add these items and subtract these items.
It's painful to watch. And the moment an exam question introduces a slightly novel scenario, their memorized framework collapses and they panic.
Rote memorization is just the enemy of genuine accounting comprehension.
It really is. The underlying logic of reconciliation is incredibly robust if you simply fire the timeline of the transaction. If we connect this to the bigger picture, the bank reconciliation statement is not an arbitrary academic hurdle designed to torture business students.
Though it feels like it sometimes.
Sure, it can. But it is a vital diagnostic tool. Every addition and subtraction you calculate on that statement represents physical capital moving or failing to move through the economy. If you understand the why behind the movement, because a check is physically traveling in a mail truck, because a bank automated a hidden fee, or because a tired clerk hit the wrong key on a keyboard, the mathematical adjustments become completely intuitive. You are simply translating a real-world narrative into a mathematical proof.
We are translating a story into math. I think that is the perfect way to frame it. Okay, it is time to wrap up this comprehensive deep dive. We are going to execute a rapid, high-level recap of the fundamental concepts we've explored to really lock in the retention.
Let's bring it home.
We began by analyzing the foundation of modern commerce, the bank. A bank is not merely a passive vault. It is an active financial partner, providing critical services like overdrafts, term loans, discounting promissory notes, facilitating international letters of credit, and executing standing instructions.
And because this relationship is so complex and high volume, it requires parallel tracking. The business maintains the cash book. The bank maintains the passbook.
And we must always remember that those two ledgers operate as mirrors of one another. Because the business views the deposited funds as an asset, a debtor relationship. A favorable balance is a debit in the cash book.
Conversely, because the bank views those same deposited funds as a liability, a creditor relationship, a favorable balance is a credit in the passbook. Understanding this flipped perspective is the absolute key to interpreting the balances correctly.
We established that we perform regular reconciliations not just for mathematical purity, but as a critical internal control mechanism to deter fraud, expose embezzlement, identify human errors, and reveal the verifiable truth of a company's liquidity.
And when the ledgers inevitably disagree, the culprits basically fall into three categories: timing delays due to the friction of clearing systems, bank-initiated transactions that occur in our blind spot, and human errors on either side of the equation.
When constructing the formal reconciliation statement, we rely on the logic of target matching. We treat our starting balance as our own wristwatch, and the target balance of the other ledger as the master wall clock.
Our sole objective is to mimic the reality of the target book. If a transaction caused the target book to be higher, we add. If it caused the target book to be lower, we subtract.
And if the discrepancies are hidden, we deploy the tick mark method, meticulously comparing debits to credits to isolate the unticked anomalies. And we must always be vigilant regarding the opening balance trap, ensuring we separate the ghosts of last month's timing differences from the current month's operational activities.
Ultimately, mastering the BRS provides a business with an unshakable grip on its financial reality.
Before we officially sign off, I want to leave you, the listener, with a final thought to ponder. We spent a significant portion of this deep dive exploring timing differences. The reality that a paper check takes 3 days to clear, or a vendor holds onto a payment for a week.
Right, the friction of time.
But the financial ecosystem is evolving at blinding speed. We're transitioning rapidly into an era of instantaneous digital settlement. Systems like RTGS are becoming the norm, peer-to-peer transfers are instant, and blockchain ledgers execute complex smart contracts in milliseconds.
It's a totally different landscape.
Furthermore, we are seeing the deployment of AI algorithms capable of cross-referencing millions of ledger entries across disparate systems in real time. This technological leap raises a fascinating question regarding the future of accounting. As the friction of time approaches zero, is the concept of a monthly manual bank reconciliation statement destined for extinction?
That's a great question.
If timing differences are eliminated by instant settlement, does the BRS become an obsolete relic of the paper age? Or consider the alternative. Will the sheer velocity of modern finance mean that when systemic errors, algorithmic glitches, or sophisticated corporate frauds do occur, they will propagate at the speed of light?
Which is terrifying.
Will this hyper-fast environment make a deep conceptual understanding of the underlying logic of forensic reconciliation more critical than ever before?
It is a profound question. I would suggest that while the physical medium will inevitably change, we're already moving away from ticking paper ledgers with pencils, the foundational philosophy of verifying two independent records against one another is immortal.
It has to be.
If a sophisticated cyber attack manipulates a centralized digital ledger, or an AI routing algorithm makes a cascading error, relying on a single source of truth is catastrophic. The ability to forensically reconstruct the intended economic reality and mathematically reconcile it against the compromised ledger will be your only defense. The speed of the transaction may approach instantaneous, but the absolute necessity for rigorous internal control and independent verification remains a constant law of commerce.
The tools evolve, but the logic remains bulletproof. So the next time it is a Friday afternoon and your internal spreadsheet proudly displays $10,000, but the banking portal stubbornly insists you only have $8,000. Well, take a breath. Don't panic.
You've got this.
You now possess the analytical tools, the target matching logic, and the forensic methodology to track down every single cent. Thank you for joining us on today's deep dive into the financial machinery that keeps the business world turning. Keep questioning the numbers, trust the logic of the ledgers, and we will catch you next time.
Imagine waking up, grabbing your coffee, and you open up your company's accounting software. You look at the bank ledger, and you see $1 million just sitting there in the green.
Best feeling in the world.
Right. You've hit a milestone. You celebrate. You immediately start planning to buy that new equipment you've been putting off. But then, just to be totally sure, you log directly into your actual bank account portal.
And this is where the panic sets in.
Exactly. The screen loads and the balance isn't $1 million. In fact, you're actually overdrawn by $50, and get this, a vendor payment just bounced. How does a business with seemingly perfect internal math completely lose track of reality?
I mean, it happens every single day. And, it's not always a case of fraud or some catastrophic failure. It is simply the friction between what a business believes has happened
Yeah.
and what the banking system has actually, processed.
Today, we are diving into the financial muddy waters of the bank reconciliation statement, or the BRS, as we'll probably call it. We are taking the source material we have today, which is honestly just packed with tables and rules and really tricky exam scenarios, and we are going to tear it down to the studs.
We really need to, yeah.
Whether you are a business owner trying to figure out where your cash went, or, an exam candidate staring down a terrifying list of accounting adjustments, the goal of this deep dive is to build an intuitive understanding.
Right, because we aren't going to just memorize what to add or subtract. That never works long term.
No, it doesn't. We are going to explore the mechanics of why money behaves the way it does when it moves between your hands and the bank's vault.
Which is really the only way to actually retain this information. I mean, rote memorization of accounting rules, it just falls apart the moment you face a real-world discrepancy that doesn't perfectly match a textbook example. So, to start, we have to recognize what these two different records actually represent. Your company maintains a cash book, specifically the bank column of that cash book.
Yep.
This is your internal diary of every dollar you believe you have collected and every dollar you believe you have spent.
So it's like the ideal reality, the way things should be.
Exactly. Meanwhile, the bank maintains a passbook or a bank statement for your account, and this is merely the bank's copy of your ledger in their system.
Which is the processed reality.
Right. It represents the processed reality. Reconciling the two, basically building a mathematical bridge to explain exactly why your diary disagrees with their processed reality is, well, it's one of the most vital control mechanisms in all of commerce.
Let's unpack the necessity of that control mechanism a bit, because honestly, on the surface, doing a reconciliation just feels like really tedious paperwork.
Oh, it definitely feels that way.
Right, you're just matching receipts. But the source material outlines some major operational reasons for doing this regularly. And the first one is catching undue delays in the clearance of checks.
Yeah, so think about the concept of float. Float is the time between when a payment is initiated and when the funds actually move.
Okay, right.
If a client hands you a check for $50,000, you write that in your cash book immediately. You feel richer.
I'm celebrating again, yeah.
But if that check gets lost in the mail, or maybe it just sits on a manager's desk or gets flagged by a clearinghouse, the money isn't actually moving.
Oh, wow. So if you don't reconcile your books, you might spend money you don't actually have yet.
Exactly. The BRS forces you to look at that $50,000 entry and ask, why hasn't the bank seen this yet?
It grounds you back in the processed reality. And I guess that leads to the second purpose, which is providing the true bank balance for your financial statements.
Right, because you can't report $1 million in assets to the government or investors if the bank only holds $100.
Yeah, that would be bad. But the third reason, highlighted in the text, is the one that really, really raises the stakes. Embezzlement.
Oh, yeah. It is the ultimate behavioral alarm bell.
Tell me more about that.
Well, let's walk through a classic scheme. Imagine a cashier at a retail store finishes a busy week. They have, say, $10,000 in physical cash.
Okay.
They record in the internal cash book. Deposited $10,000 into the bank. So the ledger looks balanced. The cash is supposedly safe. But instead of actually driving to the bank, the cashier puts the money in their trunk and just drives away.
Wow. So if the business owner only ever looks at their own internal cash book, everything looks perfectly fine, like the internal math works.
The internal math works flawlessly, but a month-end bank reconciliation shatters that illusion.
Because they'd see the gap.
Exactly. The business owner compares the books and sees the $10,000 deposit in their ledger, but a complete absence of that deposit on the actual bank statement.
Right. And if it takes 3 days to clear a deposit, that's just a timing delay. But if it takes 3 weeks, that's theft.
Precisely. The BRS ensures that the physical movement of assets actually matches the recorded movement of assets.
It's an audit of human behavior, not just a math check. I love that. So To even begin this audit, you really have to establish where you are starting from.
Yeah, the starting line is crucial.
The source material outlines 4 possible starting balances for any reconciliation. And honestly, this is where I see people completely give up.
Well, they tap out immediately.
Yeah, because the terminology feels like it was specifically designed to confuse you.
It really requires a massive shift in perspective. So the 4 starting points are a favorable balance as per the cash book, which is a debit.
Okay, debit is favorable there.
Right. Then a favorable balance as per the pass book, which is a credit.
See, that's where people lose it.
I know. Then you have an unfavorable or overdraft balance as per the cash book, which is a credit. And finally, an unfavorable pass book balance, which is a debit.
I want to stop right here because just reading that line is exactly what causes a student's brain to short circuit. Like, favorable is a debit here, but a credit there.
It sounds like nonsense until you break it down.
To make this stick, I want to introduce a mental model for you listening. Let's call it the wallet versus liability rule. Let's start with your internal cash book. Think of a favorable balance in your cash book, like having physical cash sitting inside your leather wallet.
That's a great way to picture it.
It is your property. It is an economic resource you control. In the language of accounting, things you own are assets. And assets always, universally, carry a debit balance. Therefore, a favorable cash book balance is a debit.
That is the perspective from inside the walls of your business. But, you know, the moment you take that cash out of your wallet and hand it to a bank teller, you are changing the relationship.
Right, because you no longer hold the physical resource.
Exactly. The passbook is the bank's internal record, not yours. You have to look at the money through their eyes.
Okay, so when the bank takes your money, they aren't just storing it in a little box with your name on it. They are taking it and using it to fund mortgages and car loans and whatever else.
They're putting it to work.
Because of that, they technically owe you that money back on demand. You are a liability to the bank.
Yes, exactly.
And in accounting, liabilities always carry a credit balance. So when you look at a bank statement and it shows a positive, favorable balance, it is a credit balance because they are acknowledging their debt to you.
That shift in perspective really solves the whole riddle. Like, when they say we credit your account, it literally means we acknowledge our liability to you.
It makes so much sense when you say it like that.
Now, what happens if the situation inverts? What if you write a check for more money than you actually have?
That's an overdraft.
Yeah.
You dip into the negative.
Yes. From the business's perspective, an overdraft means you owe the bank money. You have a debt. Your debt is a liability, so in your internal cash book, an overdraft is a credit balance.
But then we flip to the bank's perspective.
Right. You owe them money. To the bank, you are now a source of future economic benefit. You are basically a loan they have issued.
Oh, wow. So to them, it's a good thing.
Exactly. Therefore, to the bank, your overdraft is an asset, which makes it a debit balance in their passbook.
Once you map it to who owes whom, it just stops being a memorization game. It's just logic. So we know our starting points. Next, we have to identify the forces that cause our wallet to disagree with the bank's liability.
The friction points.
Yeah, let's categorize the discrepancies into 3 major friction points.
Friction is the perfect word for this. So the first point of friction is simply time.
Time. Yeah.
Timing differences occur because the physical reality of banking relies on a massive, complex infrastructure. When you hand a physical check to a supplier, you deduct it from your internal book that exact second.
Because I've done my part.
Right. But that supplier has to drive to their bank, deposit it, their bank has to send the data to a central clearinghouse, the clearinghouse has to request the funds from your bank, and your bank has to finally, process the deduction.
It takes days, sometimes weeks if someone is lazy about depositing a check.
Exactly. The action happened, but time delays the system from reflecting it. Now, the second point of friction is third-party transactions.
What are those?
These are actions taken by the bank or by customers interacting directly with the bank that bypass your internal accounting department entirely.
Oh, like the bank deciding to pull a $50 monthly maintenance fee?
Precisely.
They don't call you to ask permission, they just take it.
Yeah.
Or like a customer who owes you money bypasses your office and wires the funds directly into your account.
Yeah.
The reality of your bank balance has changed, but your internal cash book is entirely ignorant of it until you check the statement.
Yep, that's exactly it. And then the third point of friction is probably the most chaotic, which is human error. Just pure mistakes.
Just messing up the numbers.
You're writing down $1,000 instead of $100, accidentally recording a deposit as a payment. Both the business and the bank are susceptible to errors, though your internal records are far more likely to contain them than the bank's automated mainframes.
Okay, so we have our starting balances, and we know our three sources of friction. The source material presents two different methods for solving these discrepancies. Let's start with method one, which is direct reconciliation.
All right, let's get into it.
This is where you prepare a statement without adjusting your internal cash book first. Now, when I look at the textbook for this method, it presents a massive, intimidating table.
Oh, the matrix. It's terrible.
It lists a dozen different scenarios, crossed with 4 different starting balances, creating this huge matrix of add and subtract columns. If I'm an exam candidate, my instinct is to make 80 flashcards and just try to memorize the matrix.
And that instinct will absolutely lead you to failure.
Really?
Oh, yeah. And under exam pressure, memorize plus and minus signs just scramble in your head. You should never attempt to memorize that table. It is entirely unnecessary if you understand the underlying mechanism, which we can call the target book strategy.
I was really hoping there was a way around the flashcards. Walk us through the target book concept.
Okay, so every reconciliation problem gives you a starting balance from one book, right? And your mathematical goal is to arrive at the ending balance of the other book.
Okay.
The book you are trying to reach is your target book. The golden rule is this: to mathematically get from your starting book to your target book, you must isolate the transaction and ask yourself one simple question. What did the target book do?
Just, what did the target book do?
It completely removes all the judgment. That is the secret. You don't ask who is morally right or wrong. You don't ask what should have happened in a perfect world.
Oh.
You are simply a mathematician building a bridge. You only ask, did the target book's balance go up or did it go down relative to my starting book?
Yeah.
If the target book went up, you add. If the target book went down, you subtract.
Okay, let's put this to the test. We're going to throw away the textbook table and use pure logic.
Let's do it.
Let's assume we are starting with a favorable cash book balance. So our starting point is our internal book. Our goal, our target book, is the bank's pass book. Let's take that classic timing friction. A check issued but not presented for payment.
All right, let's visualize the mechanism. You sit at your desk, you write a check for $10,000 to a vendor, and you sign it. The moment ink hits paper, what do you do in your cash book?
I record the payment. My internal cash book balance immediately goes down.
Right. But the vendor puts that check in their glove compartment and just forgets about it for a week. So what did the bank, our target book, the pass book, do?
Well, the bank did absolutely nothing. Like, they don't have psychic powers. They don't know the check exists.
Correct. So currently, your cash book balance is artificially lower than the pass book balance. To mathematically build a bridge from your starting book to your target book, what must you do? Your book went down, but the target book didn't.
I have to reverse my action. Since my balance is low and the target book is higher, I must ADD that $10,000 back to my starting balance to reach the pass book number.
Exactly. You add it back. Not because you actually still possess the money. You definitely owe that money. But simply because you are forcing your mathematical formula to match the bank's delayed reality on this specific date.
Got it.
Let's try the inverse.
Ugh.
A check deposited but not cleared.
All right, so a client hands me a check for $5,000. I am ecstatic.
Yeah.
I write it in my cash book immediately. So my internal balance goes UP.
Yep.
But it's 4:05 p.m. on a Friday. I slide it under the bank's door, but they won't process it until Monday, and it probably won't clear until Wednesday.
So as of Friday night, what has the target book, the pass book, done?
Nothing. The pass book balance has not gone up yet. The money is in transit. So my starting book is high, but my target book is still low. To get from my high balance down to the target book, I have to subtract it.
Spot on. You subtract. Now let's look at a transaction initiated by the bank, like direct deposits by customers or interest collected by the bank on your investments.
Okay, so a client wires money straight into the account. The bank processes instantly. So the pass book, the target book, goes UP.
Right.
But I'm on vacation and haven't logged into my accounting software. My cash book hasn't moved.
Apply the rule. Starting point is cash book. Target book is pass book. What did the target book do?
The target book went UP. So to catch up to reality, I must ADD this amount to my starting balance.
Add. Perfect. And the reverse applies for bank charges. The bank pulls a monthly fee. The pass book goes down. What do you do?
The target book went down, so I subtract. Wow, this is incredibly elegant. It completely eliminates the need to memorize the entire first half of the textbook matrix.
It works every single time. But here is the curveball that ruins students on exams.
Oh, boy.
How do we handle an unfavorable or overdraft balance? The textbook table flips all the plus and minus signs for the overdraft columns. If you try to memorize that, your brain will completely invert the logic under stress.
Right, because if you are overdrawn, your starting point is basically negative money. So do we have to learn a mirrored version of the target book rule?
No, you don't change the logic at all. You just use a negative sign on your calculator.
Wait, really?
That is the foolproof method. If your exam question says you have an overdraft as per cash book of $1,000, you just write down minus $1,000 on your scratch pad. Then you proceed with the exact same target book questions.
Okay, let's test that. I'm starting at minus 1,000. I write a check for $500, but it hasn't been presented yet. My cash book went down, but the target book didn't. Following our previous logic, I need to ADD it back.
Yes. You take your minus 1,000 and you add 500. Mathematically, where are you?
Minus 1,000 plus 500 is minus 500.
Exactly. And what does that final negative number tell you? It tells you that the target book, the pass book, is also in an overdraft position, specifically an overdraft of 500. You let the arithmetic handle all the complexity.
Wait, hold on. What if the math pushes it over the zero line?
What do you mean?
Like, what if I start with a minus 1,000 overdraft, but I realize a customer directly deposited 1,500 into my account without telling me?
Just follow the rule. Direct deposit means the target book went UP, so UADD. Minus 1,000 plus 1,500 equals a positive 500.
So because the answer is positive, it means the bank account is actually in the green. Like the target book has a favorable balance of 500.
Precisely. You don't have to memorize a single flipped rule. Just start with a negative sign for an overdraft, ask what did the target book do, and let the final positive or negative outcome dictate the final status of the account.
That is incredibly liberating. It turns a nightmare matrix into just a simple logic circuit. But we really need to push this logic further into the realm of the third friction point, which is errors.
Yes, the messy part.
The source material spends significant time on undercasting and overcasting. For anyone not steeped in, Victorian accounting terminology, casting just means totaling up a column of numbers, correct?
Yeah, that's it. Casting is totaling. Undercasting means your total is mathematically too low. Overcasting means your total is too high.
Got it.
Let's walk through a classic exam trap. Undercasting the debit side of the cash book.
Okay, let's build a scenario for this. It's the Friday before holiday weekend. A retail store manager is just exhausted. They're counting the cash registers. As we established earlier, the debit side of the internal cash book is the asset side. It is the receipts, money coming in.
Right. So the manager totals up the receipts for the day. They have a stack of cash and checks, but in their exhaustion, they miss a 0 on their calculator. They undercast the debit side. They write down that they collected $5,000, when in reality, they actually collected $10,000.
So their internal cash book balance is now artificially low by $5,000. It's a self-inflicted math wound.
But the bank doesn't care about your manager's exhaustion. The manager takes the physical bag of $10,000 to the bank and drops it in the night safe. The bank's machines count it accurately. So what did the target book, the pass book, do?
Well, the pass book processed the reality. It recorded the full $10,000. So the target book is $5,000 higher than my broken cash book.
Apply the rule. To make your low starting balance match the higher target book, what must you do?
I have to ADD the $5,000 difference.
Correct. Now, what if the manager overcasts the credit side of the cash book?
Okay, let's see. The credit side is the liability side, meaning money going out, payments. If I overcast the payments, it means my calculator slipped and I thought I spent way more money than I actually did. So again, my internal cash book balance drops. It's artificially low. But the bank only processed the checks I actually wrote. Their balance is higher. So I ADD again.
Exactly. Whether you undercalculate your income or overcalculate your expenses, the end result is identical. Your internal book is poorer than reality. You must add to bridge the gap to the bank.
Okay, I see the pattern. But this leads me to a major conceptual hurdle, specifically regarding errors made by the bank.
Yes.
The text mentions wrong debit in the pass book. Let's walk through the mechanics of that. How does a bank make a wrong debit?
Usually it's an automated processing error. An account number is transposed by a machine, or a check clears against the wrong account because the magnetic ink character recognition, the MICR line, was misread. The bank accidentally pulls $1,000 out of your account to pay someone else's electric bill.
Okay, so applying our logic, my starting point is the cash book. The bank's machines screw up and wrongly deduct money. The target book went down.
which means to mathematically reconcile, I have to subtract that $1,000 from my internal cash book balance.
Correct.
I'm struggling with this, though. If I subtract $1,000 from my own ledger, I am literally copying a bank's mistake into my own math. I am deliberately making my internal balance wrong just to match their broken system.
And that hesitation you are feeling right now is exactly why people fail this topic. You have to realize what a standard Method 1 bank reconciliation statement actually is. It is not a ledger correction. You are not fixing mistakes. A BRS is essentially a quarantine document.
A quarantine document?
Yes, it is a piece of paper that says, my internal reality is X. The bank's reality is Y. We disagree. However, I can prove that no money has been stolen because if I temporarily replicate the bank's errors in my math and I account for the time delays, X becomes Y. It isolates the discrepancies and proves they are known quantities.
Oh, it's a diagnostic tool.
Yeah.
We aren't actually deducting the $1,000 from our official asset list. We are just showing the math on a separate sheet of paper to say, hey, I see your error. I can mathematically bridge it so we are balanced until you reverse this charge next week.
Precisely. You quarantine the error on the statement so the business can keep operating without panicking about missing funds.
But surely you can't just leave errors quarantined forever. I mean, if I made a math mistake in my books, doing a reconciliation on a scratch pad doesn't magically fix my ledger. At some point, the tax authorities and investors are going to want to see a balance sheet that reflects actual reality.
And that organic realization brings us perfectly to Method 2, bank reconciliation with an adjusted cash book. Because you are right, there is a time when quarantine must end and a cure must be applied.
So when does Method 2 become mandatory?
You can technically do it every month, but it becomes absolutely mandatory at the end of the financial year. When you are closing your books to create a balance sheet, you cannot knowingly present a false cash balance. Your internal ledger must be permanently repaired.
Okay, that makes sense.
So before you create the BRS to show the time delays, you must first create an adjusted cash book to permanently fix your internal records.
This splits the process into two distinct stages. Stage 1, open the ledger and fix the internal chaos. Stage 2, take that newly corrected balance and reconcile it against the bank's time delays on the BRS. But if I'm looking at an exam paper with 12 different chaotic discrepancies, how do I know what gets permanently fixed in the adjusted cash book and what gets quarantined on the BRS?
You need a foolproof sorting mechanism. The golden rule of sorting is this: fix your own house first.
Fix your own house.
Yes. The adjusted cash book gets everything you have the power and the right to change. Specifically, all cash book errors, like your manager undercasting the receipts or recording a payment twice. You also include all cash book omissions, things the bank did that you simply forgot to write down, like bank fees, direct deposits, or checks that bounced.
So fix my bad math and catch up on the bank's direct actions. That repairs my house. What goes on the BRS?
The BRS gets the things you cannot legally or practically fix right now. Timing differences like checks floating in the mail. You can't speed up the mail, so you just quarantine them. And crucially, past book errors.
Hold on, let me push back on that.
Sure.
If the bank makes a mistake, like wrongly debiting my account for that $1,000 electric bill, and it's the end of the year, shouldn't my balance sheet reflect the exact amount of cash physically sitting in the vault? Why wouldn't I permanently adjust my cash book to match the bank's error, just to be safe?
Because you cannot edit a reality you do not own. The text makes this explicit. Errors occurring in the past book are not adjusted in the cash book.
Why not? The money is technically gone for now.
Because if you record a bank error as a permanent deduction in your internal books, what account do you charge it to? It's not a business expense. You didn't buy anything.
Oh.
Right. If you record it as an expense, you are falsifying your income statement, which impacts your taxes. The error belongs to the bank. They are legally liable to return it. So your adjusted cash book reflects the true, legally accurate balance of your business. The bank's error just sits on the year-end BRS, glaring at them until they fix it.
Wow. Fix your own house. You only repair the things you control. Okay, let's put this two-stage method into practice by diving into some of the most diabolical exam scenarios we're looking at. These are the ones seemingly designed to break a student's spirit.
You really are.
Let's look at the accountant in the Gadbabwala problem who has made a series of catastrophic ledger entries.
Yes, that problem is a masterclass in forensic accounting. You aren't just doing math, you are untangling a severe mess. Let's examine the first major blunder, the December 18th flip, which we can call the double impact error.
Let's hear it.
The text says a debit balance of $15,260 on the previous day was brought forward as a credit balance.
Let's dissect the mechanics of this because it's definitely a trap. A debit balance of $15,260 means we have cash. We have a positive asset of $15,260.
Right. But when the accountant turns the page to start a new day, their eyes slip, and they write that exact number in the credit column, the liability side.
So internally, the books now say the company is overdrawn. We have a negative balance of $15,260. The distance between reality and the books is just massive. Because this is our own internal cash book error, it goes into our adjusted cash book. We have to permanently fix it.
Exactly. But how much do you adjust it by? This is where intuition fails people.
Well, the error is 15,260. So I should just add 15,260 back, right?
Let's use an analogy. Imagine ground level is 0. Having a debit balance means you are standing on a hill 15 feet in the air. That's reality. But your accountant accidentally recorded that you were at the bottom of a 15-foot hole in the ground.
Okay, I'm in a 15-foot hole.
If you bring in 15 feet of dirt to fix the hole, where are you?
I'm at ground level, 0.
But you aren't supposed to be at 0. You are supposed to be standing on a 15-foot hill.
Oh, I need 15 feet of dirt just to get out of the hole and another 15 feet of dirt to build the hill. I need 30 feet of dirt.
Precisely. To fix a ledger entry that was brought down on the wrong side, you must apply the correction twice. You must enter a debit adjustment of exactly double the amount, $30,520. That single massive entry cancels out the fake overdraft and restores the true positive balance.
That makes total sense.
Yeah, the double impact rule is absolutely essential for exams.
That analogy makes it crystal clear. Double the amount to cross the 0 line. Let's look at another one of this accountant's messes, the phantom bank column. The scenario says a deposit of $150,000 was recorded in the cash book as if there was no bank column. What is the mechanical failure happening here?
So many businesses historically, and even some software systems today, use multi-column cash books. You track physical petty cash in one column and the bank balance in the column right next to it. What happened here is a classic data entry slip.
Okay.
The business received a $150,000 check meant for the bank. The accountant recorded the receipt, but accidentally typed it into the petty cash column.
So the business thinks it has $150,000 in a drawer somewhere, but as far as the bank ledger is concerned, the transaction is a ghost. It never happened.
Exactly. For the purposes of the bank reconciliation, this is treated exactly the same as if the accountant completely forgot to record the check at all. It is a pure omission from the bank column.
So because it's our own internal omission, we apply the fix your own house rule. It goes into the adjusted cash book. We simply debit the bank column for $150,000 to officially move the money from the phantom drawer into the bank ledger.
Yes. And their final masterpiece, the double entry. The accountant recorded an outgoing check of $350,000 twice in the cash book.
So they wrote one check, but deducted it twice. The ledger is artificially drained. Again, our house, our error. We fix it in the adjusted cash book by reversing one of the payments. We put $350,000 back onto the receipt side to cancel out the ghost payment.
You are, basically acting as a mechanic, tightening the bolts on the internal machinery before you ever compare it to the bank.
Right. Let's move to the Nicky & Co. problem. This one introduces a huge psychological trap regarding net versus gross amounts. The prompt states that a customer paid an invoice after a 4% discount, but the cashier entered the gross amount in the bank column.
Ah, the discount trap. Let's run the numbers to see how this happens in reality. A customer owes you $400,000. You have a policy. Pay within 10 days, get a 4% cash discount. 4% of $400,000 is $16,000.
Right.
So the customer does the math, writes a check for the net amount, which is $384,000, and hands it to your cashier.
But the cashier is processing 50 payments an hour. They look at the customer's file, see the original $400,000 invoice, and quickly type $400,000 into the cash book receipt column. They completely ignore the discount logic.
So our internal cash book is artificially inflated. We recorded receipts that are $16,000 higher than the physical check we're actually holding. The bank is only going to process the $384,000 written on the paper. Right. This is an internal error, so it goes in the adjusted cash book. But how do you fix it mechanically? You can't just delete the $400,000 entry and start over because that destroys the audit trail.
Right. Accounting doesn't like erasers. We need to create an adjusting entry. We need to reduce our inflated bank balance by the $16,000 difference.
So in the adjusted cash book, we enter a reduction of $16,000. We label it discount wrongly entered. That mathematically drags the net receipt down to the true $384,000.
Exactly. Find the delta and apply the adjustment.
Got it.
Nicky & Co. has another incredibly tricky scenario, the time travel trap. Let's look at the out-of-date check. A debit of $1,100,000 appeared in the bank statement for an unpaid check, which was returned marked out of date. The customer redated it and deposited it again the next month on July 5th. But the problem asks us to reconcile as of June 30th.
This breaks people's brains because the problem gives you the resolution to the story. We know the check eventually clears in July, so why do we even care about June?
Because accounting is strictly bound by time. A balance sheet is a snapshot of reality on one specific second in history. When reconciling for June 30th, you must put on blinders.
Put on blinders.
The future does not exist. You must ask, what was the objective reality on June 30th?
Okay, putting on the blinders. On June 30th, the bank statement showed a deduction of $1,100,000. The bank rejected the original check because it was stale, maybe older than 6 months. The bank yanked the money back.
Correct. But what did our internal cash book show on June 30th? Months ago, when we first received that check, we recorded it as a massive receipt. We thought we had the money. Did we know it bounced on June 30th?
No, we didn't. We only found out when we got the bank statement in the mail. So as of the June 30th snapshot, this is an omission. It's a dishonored check that we haven't recorded the failure of yet. Our house is broken.
Exactly. Because it's an omission from our records on that date, it goes into our June adjusted cash book. We must credit our adjusted cash book for $1,100,000 to reverse the failed receipt and just face reality.
But I keep wanting to fix it because I know they redeposited it on July 5th.
I know, but you must resist that urge. On June 30th, that money was physically not in the banking system. You cannot use July's money to artificially inflate June's assets. You adjust it out in June. When July 5th rolls around, your accountant will record a brand new, fresh receipt in the July ledger.
It's an incredible lesson in chronological discipline. And, speaking of chronological nightmares, we have to talk about the Jane problem.
Oh, yes.
This is arguably the hardest format a student will see. It doesn't give you a neat list of text explanations. It just hands you two visual T accounts, the company's cash book for March and the bank's passbook for April.
This tests your analytical mechanics. You are no longer following instructions. You are basically a detective. When you are given cross-month ledgers like this, you have to use the process of elimination, often called the tick mark method.
Let's walk through the physical mechanics of doing this. Imagine I have the exam paper in front of me. I have a pen in my hand. I am looking at March's internal records and April's bank records. What is my very first move?
Your goal is to figure out what actions initiated in March got delayed by the clearinghouse until April. You are hunting for the float.
Hunting for float, okay.
Let's look at the debit side of the March cash book. These are receipts. Money in. You see an entry on March 6th. A check from a customer named Sales for $300,000. Now, move your eyes to the April passbook. Do you see a matching deposit for $300,000?
Scanning April. Yep, yes, I see one on April 7th. By cash, $300,000.
Excellent. Take your pen and physically tick both of them off. Now, what does the fact that they match across the month boundary tell you about our reconciliation date of March 31st?
Let me think. If I wrote it in my book in early March, but the bank didn't record it until April 7th, why did it take a whole month?
Exactly. It could have been post-dated. It could have sat on a desk. The reason doesn't actually matter as much as the mechanical reality. What was the status of that check on the midnight cutoff of March 31st?
On March 31st, it was floating in the ether.
Yeah.
It's a check deposited but not cleared. My internal book went up in March, but the target book didn't go up until April.
Bingo. The trick is this. If you find a matching amount across the month boundary, that item is a timing difference for your current month's BRS. You isolate it and apply the target book rule.
That is so counterintuitive. You look for the things that match in order to find the discrepancies.
Yep.
Let's keep hunting. In the March cash book, I see a receipt on March 10th from RAM for $65,000. I scan the April passbook, and there is no $65,000 deposit anywhere in April.
So what does a missing match mean?
It means one of two things, right? Either it cleared the bank really fast, entirely within March, which means it's in the March passbook, which we aren't looking at, so it's fine. Or it's completely lost in the mail and won't clear until May.
Let's look at the provided solution for that specific scenario to see what the examiner expects. The solution actually identifies a check from Patel For $65,000 deposited in March, but not credited by the bank till March 31st.
Wait, I see RAM for $65,000 in the question's cash book, but the solution calls it Patel?
Yeah, that happens.
Looking closely at the source text, it appears there might be a typo in the provided question versus the solution names. But the critical piece of data is the amount, $65,000. The tick mark method requires intense scrutiny. If an item is in the March cash book but not in the April pass book, it is either perfectly fine or it's a long-term outstanding item you'd need more data to confirm. The guaranteed reconciling items are the ones that explicitly appear in both lists, straddling the month line.
Precisely. You tick off the items that cross the time boundary. Those become your checks issued but not presented, or checks deposited but not cleared. You isolate them, bring them to your scratchpad, and apply the "what did the target book do" logic.
Okay, so we've done the forensic detective work. We've fixed our house with the adjusted cash book. We've quarantined the timing delays. The final step is presenting this to the boss or the examiner. The source material outlines 2 presentation formats.
Yes. The math is done. Now it's really just formatting. The first layout is the balance presentation. This is a vertical, single-column narrative format.
How does it flow on the page?
You start with a formal heading, bank reconciliation statement as on whatever specific date. You write your starting balance at the top, balance as per cash book, $10,000. Beneath that, you create a section titled Add. You list out all the items your target book logic told you to add, along with short text descriptions, putting their amounts in an inner column. You subtotal those additions and add them to your starting balance.
Okay, so it reads like a story. We started here and then we added these delays.
Exactly. Then you create a section titled Less. You list the items to subtract, you subtotal them, deduct them from your running total, and draw a heavy line. The final number at the bottom is your destination. You label it with your target book, balance as per pass book.
It's very logical for someone who just wants to read the chronological steps. What is the second format?
The second is the plus and minus presentation. This is a more visual ledger style format. You have a particulars column for the text and 2 columns for numbers, a plus column and a minuses column.
How do you handle the starting balance in this format?
It depends entirely on whether it's favorable or an overdraft. If you have a favorable starting balance, you put that dollar amount in the plus column. If it's an unfavorable overdraft, you put the amount in the minus column. Then you just go down your list of discrepancies. Everything you decided to add goes in the plus column. Everything you decided to subtract goes in the minus column.
And how do you calculate the final answer at the bottom?
You total the plus column, you total the minus column. The difference between those 2 totals is your final balance. You write that difference on whichever side is lighter to force the columns to balance, just like closing a T account ledger. The side the true balance falls on tells you whether the target book ended up favorable or overdrawn.
The plus and minus method feels much faster for an exam if you have 15 different items, because you are just dropping numbers into buckets without having to keep a running narrative total.
It definitely saves time.
But either way, the underlying mechanics, the target book logic, never changes.
Formatting is just preference. The math is universal.
We have covered an immense amount of ground today, from the psychology of embezzlement to the geometry of zero-crossing ledgers. I want to do a rapid-fire chapter recap to cement this for long-term attention.
That's the perfect way to close. First, the core objective. Understand the difference between the 2 reconciliation methods. Method 1, direct reconciliation, is a temporary quarantine. You don't change your ledgers, you just mathematically prove why the books disagree.
But method 2, the adjusted cash book, is a permanent cure. It is mandatory year-end because your balance sheet must reflect reality.
Second, remember the 3 friction points. Time delays, which is float third-party transactions like bank fees or direct deposits, and human errors.
And the most vital tool we learned today, the target book strategy. Do not memorize the textbook matrix. To solve a BRS problem, identify your starting book and your destination book. Ask, what did the target book do? If the target book went up relative to your start, you ADD. If it went down, you subtract.
And if you start with an overdraft, just put a negative sign on your calculator. Keep the exact same add-subtract logic. Let the final positive or negative outcome tell you the status of the account.
We also built some mental models today. If you freeze on an exam trying to remember if a favorable balance is a debit or credit, use the wallet versus bank liability trick. Cash in your internal wallet is your asset, so it's a debit. But when the bank holds it, they owe you. You are their liability, so it's a credit on their statement.
And for method 2 sorting, use the rule. Fix your own house first. Only put your own internal cash book errors and omissions into the adjusted cash book. You cannot edit the bank's reality, so bank errors and time delays stay on the BRS statement.
We spent this entire time treating these ledgers as mathematical puzzles to be solved. We've talked about friction and float, but I want to leave you with a thought about the practical reality of running a business. Think about the psychology of the errors we discussed today.
The human element.
Exactly. If you are a business owner and your accountant brings you a bank reconciliation statement every single month that requires massive adjustments for undercasting the cash receipts or constantly finding phantom bank columns, at what point does it stop being a math problem?
It becomes a behavioral pattern.
The BRS isn't just an accounting requirement. It is a surveillance tool. At what point does a consistent error become evidence of the very embezzlement this statement was designed to catch? If someone is always forgetting to record cash receipts, maybe they aren't exhausted. Maybe they are testing the fences. Next time you balance a checkbook or review a month-end close, ask yourself, are you just doing math or are you auditing human behavior?